Unless you've been living under a rock, you've probably heard of one of the biggest banking failures in U.S. history. That's right, one of the biggest banking failures of all time, and I'm talking about Silicon Valley Bank. A whopping $209 billion in total assets when it collapsed, ranked next to Washington Mutual Bank in the crash of 2008. But what exactly led to this great bank's demise? Today, we'll uncover the truth behind the collapse of Silicon Valley Bank and why it could trigger yet again another financial crisis. In this channel, we do tons of research about the stock market, and our goal is to help you on your journey to financial freedom so you can live life on your own terms. If you like this video, make sure to destroy the like and subscribe buttons so that you won't miss any of our future content. Now, just a few months ago, Silicon Valley Bank became one of the most influential financial institutions in the technology industry. Founded in 1983, SVB has played a crucial role in the growth and development of some of the world's most innovative and successful companies, providing them with the capital, expertise, and network they need to succeed. Over the years, SVB has evolved from a small bank serving the needs of local startups in Silicon Valley to a global financial institution with offices and innovation hubs across the world. But let's be honest, Silicon Valley Bank is more than just a bank. It's practically a Silicon Valley institution. It's like the cool uncle that everyone wants at their family gatherings, except instead of bringing homemade cookies, it brings venture capital and connects you with potential investors. It's the ultimate wingman for startups, always there to support and guide them through the ups and downs of the tech world. And let's not forget about the perks that come with being a Silicon Valley Bank client. Access to exclusive events, networking opportunities with other tech leaders, and even the chance to hang out with the SVB team at their famous Banks, Brews, and Bites gatherings. Who needs a boring old checking accountant when you can have all of that? In short, Silicon Valley Bank is more than just a bank. It's a community of innovators, disruptors, and game changers. And if you're lucky enough to be part of that community, you know that the sky's the limit. Well, that and the fact that you'll probably have a lot of fun along the way. Silicon Valley Bank was founded in 1983 in Santa Clara, California, and has since then become the go-to bank for entrepreneurs, innovators, and investors in the technology sector. The bank has branches across the United States, as well as in Europe, Asia, and Israel, and provides a wide range of banking services tailored to the needs of startups and growth stage companies. One of the key advantages of banking with Silicon Valley Bank is its deep expertise and network in the tech industry. They understand the unique challenges and opportunities that tech companies face and offer specialized services such as venture debt, corporate finance, and strategic advisory. Now, what exactly happened that led to this promising bank's demise? Gregory W. Becker, the president, chief executive officer, and director of Silicon Valley Bank, can probably bet that his day began like any other Friday morning. Several meetings in the morning and possibly a game of golf in the afternoon to start the weekend. Granted, the public sale of the convertible bond had caused some concern, but General Atlantic, a venture capital firm, was planning to raise capital through new equity to reassure investors. This initiative was anticipated to be routine and all but guaranteed because the bank was strong, healthy, and liquid. Well, let's hope Gregory W. Becker's game of golf went better than the public sale of the convertible bond. I mean, who knew that finance could be more unpredictable than a game of mini golf? But in all seriousness, it's understandable that there was some concern around the convertible bond sale. I mean, it's not every day that you see a bank of Silicon Valley Bank's caliber raising capital through new equity. It's like seeing Bill Gates selling candy on the street corner. It's just not something you expect. But with General Atlantic backing the initiative, it's no surprise that investors were reassured. After all, they were a venture capital firm. They know a thing or two about investing in the future of tech. It's like having a golden seal of approval, but instead of a seal, it's a group of highly experienced investors. And let's be real, it's not like Silicon Valley Bank needed the money to pay off its debts or anything. They were already strong, healthy, and liquid, like the green smoothie of the banking world. So, with all of that going for them, it's no surprise that the public sale of the convertible bond ended up being a success. I mean, who doesn't love a good green smoothie? For instance, during the COVID-19 pandemic, its deposits increased by 215% between 2019 and 2022 to conclude at $189 billion US. Additionally, it had a rich history that had been built up over 50 years. Accordingly, nothing could have prepared Becker for the day's events, which included a traditional bank run on the institution he had spent more than 3 decades constructing. So what led to its collapse? A series of seemingly unimportant choices led to the unexpected end of a prosperous bank's trajectory in less than 30 hours. Customers of SVB lost confidence as a result of this comedy of errors. In the world of money, trust and confidence are vital, and even the smallest error can have disastrous results. The New York Times reported that Silicon Valley Bank made a number of unintentional mistakes. So imagine you have some money and you want to make more money out of it. One way to do this is to buy something called a bond. A bond is like a fancy IOU. You give your money to a company or bank, and in return, they promise to pay you back with interest after some time. One type of bond is called a HTM AFS mortgage-backed bond, which is when the company or bank uses the money they get from selling the bond to buy a bunch of mortgages. Mortgages are what people use to buy houses. Now, the company or bank can decide whether to keep the bond until it's paid back, HTM, or sell it before it's paid back, AFS. If they sell it, they might make more or less money than what they paid for it, depending on how the market is doing. In this case, a company called SVB bought a lot of HTM AFS mortgage-backed bonds with some of their money, hoping to make more money out of it. But then, the government raised interest rates, which made it harder for them to make as much money as they wanted. So they decided to sell some of the bonds at a loss, which means they sold them for less than what they paid for. They did this because they thought they could make more money by investing in something else instead. But when other people found out that SVB sold some bonds at a loss, they got scared and thought SVB might not have enough money to pay its debts. This caused the value of SVB's company to go down. SVB then tried to fix the problem by getting more money from another company, but that made things even worse. In the book Stress Test, Timothy Geithner, who used to work for a big bank in the United States, talks about how important trust is in the financial system. Trust means that people believe that banks and other financial companies will do what they say they will do and that they are being honest with their customers. Without trust, the system can't work well. When a bank loses the trust of its customers, it can be very hard to get it back. This is what happened to Silicon Valley Bank, SVB, which is a bank that failed because people didn't trust it anymore. Other experts, like Mohammed A. Ellerine, also talk about how important it is for banks to have a good reputation because it's easy to lose and hard to get back. But it's not just about one bank. When one bank fails, it can cause problems for other banks and for the whole economy. This is because banks are all connected like a chain. If one link in the chain breaks, the whole system can collapse. For example, when some banks in Dubai and Kenya failed between 2015 and 2020, it caused problems for other banks too, and even now, some banks still haven't recovered. So it's really important for banks and other financial companies to be trustworthy and to take their actions carefully because they can affect many other people and businesses in the economy. So what is the Fed doing? Government bailout was a no-go. SVB's remaining assets will be distributed to creditors and it will remain in collapse. If another bank purchases it, a buyer could revive it. The government promised to cover all deposits at SVB on March 12th. However, stockholders and unsecured creditors are not covered by this guarantee. The FDIC established the Deposit Insurance National Bank of Santa Clara to house both insured and uninsured deposits because Silicon Valley Bank has closed. Silicon Valley Bank SVB was in trouble and couldn't pay back its debts, so the government decided not to give it money to help. As a result, SVB had to close and give the money it had left to the people it owed money to. If another bank wants to buy SVB, they can and maybe will make it work again. The government promised to cover the money people had in SVB, but only up to a certain point. The people who owned shares in SVB or loaned money to SVB are not covered by this promise. The government made a new bank called the Deposit Insurance National Bank of Santa Clara to take care of the money people had in SVB, both the ones that were promised to be covered and the ones that weren't. People who had their money in SVB and were promised to be covered could get their money back from the new bank. People who had more money in SVB than the promised amount will get some of their money back from the new bank now and the rest later when the government sells SVB's things to get more money. The situation with SVB might make the Federal Reserve, which is in charge of the country's money, be more careful when deciding to increase interest rates. Smaller banks that are connected to industries that don't make as much money, like technology startups, might be affected more by the situation than bigger banks that are more diverse. The FDIC typically sells the assets of a bankrupt bank to third parties. These funds will be used to pay down uninsured depositors. SVB Financial Group, the previous parent firm of Silicon Valley Bank, submitted a Chapter 11 bankruptcy petition on March 17. After SVB Financial Group was the object of a civil complaint brought by Silicon Valley Bank stockholders, this filing was made. Assets will be sold by administrators to settle creditor claims. Silicon Valley Bank is not a part of this bankruptcy filing because they are under the control of the FDIC. Now, where's their stock at? At the time of this video, it's down a fraction of a dollar. A few months ago, it was trading at $323. $323. Should you catch a falling knife? I don't think so, unless you want to get hurt. So what can we learn from the Silicon Valley Bank's demise then? Recognizing the value of trust and reputation in the financial services sector, we must take action to protect them. Banks must put their customers' and investors' interests first, conduct themselves ethically, and be open in all of their interactions. Before taking any action, all options must be carefully considered to ascertain the possible effects, and all stakeholders must be informed in a clear and straightforward manner. Well, it looks like Silicon Valley Bank learned the hard way that reputation and trust are like a Jenga tower. One wrong move and everything comes crashing down. And trust me, nobody wants to be the one responsible for ruining game night. But kidding aside, the failure of Silicon Valley Bank should serve as a cautionary tale for other banks and financial institutions. Reputation and trust are priceless assets that take years to build but can be destroyed in a matter of seconds. It's like building a sandcastle. It takes time and effort to make something beautiful, but one wave can wash it all away. So let this be a lesson to all corporate leaders out there. Don't take your reputation and trust for granted. They're the foundation upon which your business is built, and without them, you're just a house of cards waiting to fall. And on that note, we hope you enjoyed this video and learned something valuable. If you did, don't forget to give us a thumbs up and subscribe for more finance-related content. And if you have any funny Jenga stories, we'd love to hear them in the comments below. See you in the next video.